Well, I feel like it's finally time for me to correct the record on whole life insurance because maybe I've been wrong all this time. Hey, it's Matthew Decker of Leverage Wealth Management, and I also run Cash Value Life Insurance Reviews here on YouTube. Now, I talk a lot about Index Universal Life Insurance. I talk a lot about whole life insurance. I talk a lot about current assumption VUL, pretty much anything that relates to fixed products in the financial planning world. So that's life insurance, that's annuities. Those would be the two major things that we spend a lot of time talking about here on YouTube. And if you've watched many of my videos, you've probably come away with this feeling, this sinking feeling that I hate whole life insurance. And I could see why you might think that because I've been pretty hard on whole life insurance in the past. And some things happened to me over the last couple weeks that have me rethinking my stance. And I might even go as far as saying I've been wrong all along. So we'll get to that in a second. Before we kind of get to where maybe I was wrong, I want to first just kind of recap the things that I have been saying about whole life insurance because there's still a lot of good information in there. And I'd like to just kind of refresh our understanding on whole life insurance. It's not going to be super in depth because a lot of the things I've said still hold value. And so we'll link the whole life insurance videos up here on top. That way, if you want to kind of go investigate yourself, you can do that. But let's get right to it. So let's talk about some notes on whole life insurance. So the first thing to know about whole life insurance is that it's going to be guaranteed. Now, when we say that whole life insurance is guaranteed, it's really guaranteed in a couple ways. So whole life insurance is going to have a guaranteed death benefit. So as long as you pay the premium that you're supposed to pay, the death benefit is going to be there. It's a guaranteed death benefit. They're also going to have a guaranteed premium. Now, what that means is if you start with a $500,000 death benefit policy, they're going to tell you what premium you have to pay, and that premium is never going to go up as long as you pay that stated premium, the premium being guaranteed, the death benefit is guaranteed. So you have a guaranteed death benefit, you have a guaranteed premium. The last thing that you're going to have in pretty much every whole life insurance policy, in fact, I think every whole life insurance policy is going to have these three guarantees. You're going to have a cash value guarantee. And what that means is if you pay the premium that you're supposed to pay for the death benefit that you purchased, you are guaranteed to have a certain amount of cash value in that policy, no matter what happens. Okay, so that's basically how whole life insurance is built. You have a premium guarantee, you have a death benefit guarantee, you have a cash guarantee. Now, with all these guarantees, just something that you need to know, every time an insurance company adds a guarantee to one of their contracts, what that should mean to you is it's going to be more expensive. Because the way these products work, it's not like your bank. You put money into your bank, the bank doesn't hold that cash, they loan that cash out. There's no guarantee on your money over the FDIC guarantee. Okay, so that's the only guarantee you're getting from a bank. In life insurance, it's quite a bit different. If you give a life insurance company money and they have guarantees in their contract, they have to hold cash in order to back those guarantees. And if the life insurance company has to hold cash to back guarantees, it means they can't invest that cash. At least not in risky vehicles, right? They have to be able to show that that money is going to be there to back the guarantees, which means they can't invest in high risk vehicles because there's no guarantee in some of those high risk vehicles. So every guarantee that a life insurance company or an annuity company adds to a product is going to increase the fees. It's just how it works. Now, if you were to compare that to the vehicle that we talk about most on this channel, which is Indexed Universal Life, it's going to look quite a bit different because Universal Life doesn't have near the guarantees that whole life insurance has. So what do we mean by that? Well, in Index Life, we'll just call it IUL, what's guaranteed? Well, if we take this cash value guarantee, the only part of the cash value that's guaranteed in an index universal life insurance policy is they guarantee that you have a 0% floor. So that means your money's not going to go backwards because the market is down. Now, you still have to pay fees, but that's not what this is saying. What this is saying is if the stock market or the S&P is down 10%, you're not going to realize that 10% loss. You're just going to get a 0. So that's the guarantee in indexed life. There's not a growth guarantee in most policies. Now, some policies will have a 0.2% or a 1% or a 2% guaranteed floor, but by and large, let's just say that an index universal life insurance policy, it's not going to have the same type of cash value guarantee that a whole life insurance policy would have. What they're guaranteeing you is that 0% floor. In terms of the premium, there's not really a premium guarantee because they give you flexibility with your premium to pay more or pay less. And so an index universal life policy is not going to have a premium guarantee if it's built for cash growth. We'll put a little asterisk there for now because we'll come back to it. Same with the death benefit. The death benefit is going to be guaranteed for some certain amount of years, but it's not going to be guaranteed for life. Why isn't it going to be guaranteed for life? Well, they can't guarantee it for life because they're giving you flexible premium. And so if you decide not to pay premium, they can't, they're not going to give you the guarantee if they're also going to give you premium flexibility. Now, there's an asterisk, I said, so let's talk about that. There are some IULs that will give you the option to add riders that will provide a death benefit guarantee. And with that death benefit guarantee, it comes with a premium guarantee, meaning if you pay this premium, this death benefit will be guaranteed. But something to know, typically those are not put on cash building products. So there is an IUL that is a death benefit focused product. Okay, so if you want guaranteed death benefit, and you want it on a policy that has the opportunity to grow cash, those index life policies do exist, and there's a place for them, but certainly most people in the index life space, they're looking for maximum cash. And that's why they're pursuing those policies. And if you're looking for maximum cash, what you would want to eliminate would be all the things that are going to increase the fees. That pretty much goes without saying. I don't think that that's too controversial. All right, so let's talk about crediting on whole life insurance policies. We talked about the fees. Let's talk about how you earn interest. And so when it comes to how you earn interest on these whole life insurance policies, it's really pretty simple. Now, we'll set aside any maybe unique products that have some kind of niche market, and we'll just focus on the bulk of the products that all function the same way. And that is, you're going to get some kind of dividend from these whole life insurance policies. Now, the word dividend is being used differently in whole life than it would be used in a traditional investment. What I mean by that is they might quote you something like a